And we're back with another conversation here. Brad Ladisaw, Corey Siegel, SNL Capital Group, coming with a little bit of a new setup, a little bit of a new energy. I realized my opening on the last one was a little lackluster, so smile a little bit more, carry a little more energy. We got to hook them. Got to
I was
hook
gonna.
them in the first
That's it. You came out a little flat. Fucking
flat,
bend the
dude.
knees. Bend the knees on those free throws,
Oh,
baby.
oh
Holy
my
cow.
God! Just remember to breathe. I'm not really opposed to public speaking or anything like that, but yeah, man, it's been an interesting couple of days. I mean, I'm not even going to let you do an intro because I think it's important for us to talk about it, and I want to jump into SB 681. That is now AB. What is it? AB. These bills that are trying to be snuck in. AB
130.
130. That's what it is, and first and foremost, before we jump into the bill, I think a real important question for people to understand or at least learn more about is Brad, as everybody should know, is president of the California Mortgage Association. It's a great organization for advocacy, specifically for this bill, right? I mean, for situations like this, I think without getting too fluffy, give me some reasons why being a part of CMA is important, is valuable. I think one of the questions I wanted to ask you about that would be like, how do you even find out about these changes in law if you're not involved with an organization like CMA? I've actually thought about that a lot lately. We would be completely in the dark, reliant on social media postings that we're probably doing to help other people. But at the same point in time, give us your 30,000 foot view of CMA and the importance of the advocacy, and then we'll
Sure. And
dive into what this is
I
going
don't
on.
think we have. I don't think we have enough time for that. The line I always like to use. I didn't join CMA to quadruple my business. I joined CMA to increase the chances of still being in business 10 years down the road. So CMA is a nonprofit trade association that represents the asset-based lending industry in California. Been around before conferences were cool. The the major pillars are education, best practices, networking, and advocacy. And the advocacy point is, I think, the biggest, one of the largest value adds that CMA brings to the table that lenders, investors, brokers are not really aware of. We have a gentleman named Mike Belote, and his company is that they are lobbyists that represent California Mortgage Association as the United Trustees Association. We're not their
Okay.
only two clients, but they literally review every single bill that comes out of Sacramento, combing it for language that can negatively impact our industry. And we are currently going through that currently where we had a SB 681. I'm not going to get into the weeds. There's language in that bill that would, and it is our belief, upend the junior position debt space in the state of California, making a lot of second position loans virtually unenforceable overnight. CMA, as part of the advocacy, we have a legislative or lobby day where we'll get members that go up to Sacramento. We set 18 meetings last month in May, and we're sitting down with legislators or their chiefs of staff or their staff just to put a face to the name, get out from
Right.
behind the logo, and educate them on some of the potential negative implications. I don't want to call them ideas, but their ideas, their their laws can have on the industry. And there's a very much butterfly effect or ripple effect that can occur. But we had a very productive lobby day, and we shared a lot of great information. On Tuesday of this week, part of a budget trailer bill, they snuck in the language that was in SB 681 into
Right.
AB 130. This is a 215-page bill, and we're only concerned about the 3 pages.
Wow.
So Mr. Belote has been on Wednesday, was at their hearing all day, just waiting for the opportunity to present our case. And it was heard, but as of right now, not heard loud enough. So
Really?
there's going to be one more hearing on Monday, to where ideally he'll get an opportunity to present again, and then this bill can be packaged up for a vote Tuesday afternoon and on the governor's desk as early as uh, Monday evening, and it'd be effective almost immediately.
Well,
So
the interesting
it's
part about it is
yeah.
when you guys went up to lobby, I unfortunately had to miss that for the 6U softball tournament that I was coaching, and unfortunately, we did not prevail. So I wasn't as productive as you guys were up there. I thought the interesting part about preparing for that trip, I got a little peel behind the onion or look behind the glass, I guess you would say, was that the folks that were involved with that were requesting us to think about stories that we have implicated or implemented in our business, but also outside of our business in just the mortgage industry in general, on how something like this can negatively affect a consumer, a homeowner, not just an investor, right? And ultimately speaking, I kind of took one of your examples when I posted about this on LinkedIn, where I said, a lot of people will take out a HELOC or a second loan to put their kids through college, right? And this is something that you brought up, and I never really thought about. I tend to get very narrowed in on the investment side of things. And realistically speaking, that type of story hits home, right? Because there's a lot of people who want to do things to their house to create a better living environment or send their kids to college. And if something like this passes and second position loans and junior loans become effectively obsolete, right? That's a huge concern.
Yeah, it's interesting on the language. Not going to bore everyone on the language, but in effect, if you're a lender and shoot, let's say 75% of the loans you write are potentially unenforceable based on a procedural issue.
Right.
What if it's 15%? Heck, if it was
Right.
us, if it was five, potentially 5% of our loans are unenforceable, we're no longer offering that loan product.
Oh yeah.
And so that hurts, and it's not really on the investment side. That is part of it. That's how we butter our bread, if you want to call it that. But on the consumer, you take, unfortunately, debt and credit drives most markets and growth. You take liquidity out of the marketplace, you tend to have a little bit of pain. That's kind of what we see with the Fed, right? When they're with
Right.
implementing their monetary policy. It's econ 101. But it's it's far more reaching than just the lenders themselves. I mean, look at loan servicers, for example. What if a majority of your business is servicing junior position loans? Some of the
Right.
certifications they want are that they say are unlawful or actually might be required
Yeah.
by federal law to do. So you can't cert everything. And if you say, hey, I'm no longer going to be servicing junior position loans, now you have this junior debt getting pushed to individuals, back to
Right.
institutional lenders. I mean, it is so far reaching. And hopefully the light comes through and they're like, oh my goodness, this will be freaking doomsday. And it, too, like election day, too close to call. So we'll see. We got Monday. Mike will be out there, and can only do so much. We're
Right.
all only so many hours in the day. You can only call your representative's office so many times. You can only educate so much. But I think that is one of the biggest footprints CMA does have is
Right.
the relationship in Sacramento. And it's being a CMA member is not only saying, "Hey, I'm there for compliance and education." I mean, our members are part of a bigger footprint and impact on our
Right.
industry, that when we're all long gone and no longer doing deals or writing loans in the state of California, some of the stuff that CMA has done over the last few decades and what we're currently doing right now is setting the framework to allow lenders 15 years down the road to operate. And
Right.
that's one of the biggest things I want to highlight about CMA. It's like you're part of something bigger than just a networking group or a
Right.
conference that you're going to talk about how great your business is.
Yeah.
Shit, deals are tough right now. Like, not
I know.
everyone could be doing great. So what are we doing procedurally to make sure our infrastructure is sound, we're compliant, and we're setting the framework to be more efficient when deals do pick up. And you get a
Right.
lot of that from attending CMA. It's not just about brokering deals, it's making sure the structure is there. But
Yeah.
anyways,
Well,
it's
I
enough
mean, I
about
didn't
CMA.
mean,
Yeah.
I didn't mean to hit you with such a heavy topic when we try to keep these things light and bright. But,
Ah, I'm
the
drinking
fees.
too early on a Friday. I
Oh
mean,
my
it's
God, I'm not
hey,
trying to
it's
make you
one.
do
Oh,
that, man.
it's afternoon. Hey,
Yeah, exactly right. I mean, it's 5 o'clock somewhere. That's a good saying that a lot of us live by at some point in time. So, um, but
I
yeah,
got a
man, I
question.
think.
Hey, go ahead.
Well, I was just going to wrap up the CMA thing. I think my joke with Brad and when you would come back from a seminar or a conference is, man, what kind of disclosures are we adding to our loan docs, right? And it was kind of one of those things where when you're in the moment, you realize that advocacy and liability and compliance, those are evolving things. Those are things that you want to think that you're up to date with, right? And you want to feel confident in the processes that you have, because ultimately we're representing to an extent investors who have large amount of capital in one particular transaction. You're also on the front end representing a buyer. Obviously, once the transaction closes, your agency kind of goes to your investors, right? And so
If you have the right
if you
disclosure,
have the
just
right
saying.
disclosure, right? Just exactly. Shout out to our lawyers. And so, my joke was like, oh man, how much more difficult on the sales side is this going to be after a conference? The more that I am involved with CMA, as like, I was actually thinking about this too. You're the president of CMA, so does that make me FLOTUS? What does that make me? I don't know. The
I don't
first,
know. I'm gonna have to
we got to figure that
present that
out,
to the
dude.
board, see what they say.
I mean, listen, I feel like I should get access to the continental buffet either way, anyways. But no, I think it's like by association is what I'm going at. Is the amount of stuff that I learned from what you bring back from those conferences has truly been invaluable to our business. So we can wrap up the CMA thing. I think if you guys are looking for more information about this new AB 130, look it up. You're in the lending space, you need to know this details, especially in California. Whether you're on my page, Brad's page, I think we even shared it on our SNL Capital Group page as well. The reality is certain things like this get slipped into bills. And this is a perfect example of inefficiency and what is meant to be a good thing, right? Policy is typically meant to improve situations, but like you said, the verbiage, and read up on it and take a look at either of our LinkedIn pages to kind of learn more. And I just wanted to bring that up at the top of the show here, just to kind of get that off our chest. So go
Yeah.
ahead, the floor is
Okay. Now,
yours.
now I could breathe again. It's
Good.
but it's funny. I don't want to be a whole conversation on CMA, but if we're going down this compliance rabbit hole, I mean, how many times do you get a phone call from somebody trying to broker us a deal, and we find out they're not licensed, and then their counter is it's a commercial asset. I don't need to
Right.
have a broker's license or a
Right.
license. It's like, no, hard stop. This is the state of California. You need
Right.
a license to negotiate terms on debt and
Yeah.
loans.
And as much as we want those laws to be different in certain cases to increase
like
volume and
it's like,
loans, I
damn,
would
it's
say,
25% loan to purchase price and
right?
you're not licensed. I'm just kidding.
Guys
I
willing
don't
to
think
pay
we've looked at a 25%. But
guys willing to pay 12 points. Get out of here. Let's do this,
oh, do
But
you have three of them? Like, let's wrap them up. Let's go. All right, I want to. So on the topic, I mean, oh, shit, we joke around on social media, LinkedIn, uh, how you get into some bubbles and everyone's just killing it. Everyone is slam. Fucking deals are easy. It's.
Jesus.
I want you to share lost deal of the week. Just
Lost
happened.
deal of the
I
week.
think the one I want to
This
highlight
morning?
just yeah, the one this morning. On
Oh man. Yeah, I mean, I
j-
think so shout out to Dylan. Dylan is with Fidelity, and
Dylan Freeman.
Dylan Freeman, right? And he had a great post, right? Because this is what you and I talk about all the time. Everybody can't be busy. There are far too many real estate agents in this market. There are far too many investors. There are far too many commercial folks. Not saying that having too many is bad. I'm just saying it's typically the 80-20 rule. 20% of the people are doing 80% of the business. So the heavy hitters are genuinely always busy. But social media will lead you to believe that everybody is busy. And what I appreciated about Dylan's post was the honesty about how like things happen. Things come into the pipeline and they go out. And I did a funny meme, like, hey, it's your first time, experiencing this, even though it
Oh, that
probably hasn't been, right? And it happens to all of us, right? And so I was once told back in the day, like, hey, if something falls out, that's okay, just replace it. And that always chapped my ass because it's like you don't really truly replace a deal. You find a new one, but it doesn't really replace the deal that you have. That new one that you're finding, you're hoping to go in addition to the one that you just lost out on. But the deal of the week that it's fallen out was a relatively straightforward transaction that we have, brought to us by a great, I would say, broker affiliate, broker partner that we have. And the interesting part about it is the resources that a lot of us lenders provide to our clients on the front end make it so that it's very much more a difficult pill to swallow when the deal falls out or goes elsewhere. So,
what do you mean by resource? What resource?
I mean like pre-approval letters or pricing or front-end valuations. There's a lot of work that goes into trying to earn that business, all work that we enjoy doing. This is not a complaint on the work.
Yeah.
To try and be a resource. That's what we want to do. We want to be a resource. But we're not a big box company, right? We're not that situation where it's like, just submit your address into a portal online. No human's going to look at it until you start sending documents in. We want to win on service. And so the pre-approval letter was issued to the client. Client provided that pre-approval letter to the listing agent, locked up the deal, and then it's the old, my play on words is the wires in the mail, right? It's not the checks in the mail because that's actually honest, and a wire can't be in the mail, so that's a bold-faced lie. But the client was communicating and open and saying, hey, I'm going to send you all of this stuff today. I'll get it to you by this afternoon. Client has some family stuff going on, so we took him for his word, let him kind of go. We get an email this morning saying that he is going to save 1.5 points on the transaction if he goes with somebody else. And not to dive into pricing too much, but we were priced at 1.5 on that particular transaction. So my initial thought was like, he's getting a free loan. And we're waiting on clarity on what he means by that. It could mean the spread between a combination of origination and maybe interest rate. It could be the rich uncle that comes into the game, or an investor. It's not literally the uncle that will say, hey, I'll just give you this loan for a rate of return. Those are few and far between, though. And the interesting part about it that, Brad, you and I talk about all the time is when we...
And I have the clarity on who's doing it.
Well, when we get off of this, we'll figure it out, because I definitely want to know. The issue that we have is two-pronged. One is nobody likes to be, all right, earmuffs, dicked around. And so, providing the resource, the ability, the pre-approval to lock up the property gives you some level of confidence that you can have an opportunity to get that deal. The other part of it is, if that property is locked up with a pre-approval from our company, and then the client decides to go elsewhere, there's enough of a stain on the private lending industry as it is, right? And some of it's warranted. There are some folks out there that don't perform. There are some folks out there that bait and switch. Not everybody. We know plenty of people that don't. But the concern that I always have is a listing agent looking at a letter from, let's say, S&L Capital Group or whoever it is, and then that buyer goes and starts working with somebody else, and it's a shit show. But nobody has told that listing agent that we're no longer working on the deal. At some points, I find a responsibility to reach out to the listing agent and say, hey, I just want to let you know, like, we were given a crack at this deal. We didn't end up winning it. That's how the business goes. No big deal. But I just want you to know, like, we're no longer involved in this, because ultimately I know they locked the property up with our pre-approval. And if things go south, not saying that they will, I don't want you to associate this transaction with my business. Do we do that all the time? No, because we're not trying to grenade the transaction in the eyes of the buyer either, right? We're not trying to do them wrong. But at the same point in time, like, that's a deal that came in a couple days ago and goes out a couple days later. Relatively straightforward deal for us to do. The old adage of don't count your chickens before the eggs hatch is very true. And the longer you're in this business, no matter what side you're on, the more calloused over you get and realize that it is part of the business. But yeah, it is what it is.
I think you make a great point on talking to the agents. We're not going to just go and try and grenade the deal, but there are times where I know either I've done it like once, but typically your point of contact is on the pre-approval letter. That agent is calling you saying, hey, are you real? Like, you could close this quickly. You walk them through the process,
Yeah.
explain the process, make them comfortable, because it's all about confidence in the process, let
Right.
alone some of the other things. But they accept the offer, and then the borrower switches lenders. In that instance, we we have to call the agent
Yeah.
because we explained. Half is a strong word. There's a higher probability, probably closer to 99.9% chance that we'll call that agent just
Right.
in good faith to say, hey, I know I walked you through our process. Like, we're moving. I'm sure the borrower's in good hands, but they're deciding to go a different way with the debt
Exactly.
on
Exactly.
that. Because if it does get bumpy, they're going to call you and say, hey, Corey, what's the update? You're like, what do you mean? I haven't touched this file in 12 days. We were expecting to fund it 3 days ago. So there's times that making the call is important.
Yeah. Well, I mean, I would echo that. I think if there's a
I think building
initial
rapport. I think you had
conversation,
a great example on building rapport with an agent on that.
well,
Just a
I mean, so
credibility integrity check.
and that's where, like you said, have is a unique word to use because it's not a requirement. But I would say if there's an channel of communication with the agent in order to get the property locked under contract where they do call to verify. I love when agents do that because we can talk them through the process. In our case, like it's you or me. We're on the logo. I mean, we are loan committee. This is kind of part of our service play. We can explain to them the timeline in great detail, right? And so that if that's the case, and then it gets pulled, yeah, I'm going to make that phone call, right? I think ultimately honesty and transparency is very important. Plus, I owe it to them. They called to check on me. I'm going to call to check on them. Hey, just want to let you know we're no longer involved. If we can help you out on anything else, if it's a pre-approval letter that gets a deal under contract, the agent doesn't call, nobody verifies, all that kind of stuff. We'll see what ends up happening. I'm not sure. I don't want to add the stress into the transaction, but I could see it both ways. Really, I can see us having a real strong case to make that call. I could also see not making that call and not trying to rock the ship too much. So ultimately, we don't get deals unless we have borrowers. We're not trying to do anything to make their lives miserable. As much as it stings, I would say, if you're in sales or if you're in private money, regular mortgage, whatever it may be, you never want a client to not be successful, right? Whether they're with you or they're not. You hope that you can win on process and service. If they decide to go to somebody else, if they have experience working with us, I want it to be hammered home that the process was not as enjoyable as it was with us. The only way that they're going to learn that is by going through it. And sometimes they enjoy the process. So, it's not really our place to kind of pull the linchpin on the deal
And I
there.
and I
That's the,
think we're building rapport, establishing relationships. At the end of the day,
yeah,
it's a business for us, it's a business for our investors, and it's a business for our borrowers. So if you're going to get 85 and 100 at 0 points, you're going to probably take a flyer on that if you got a 21-day close. It's like,
right.
that is $1 million loan amount. That's a sizable chunk of change
Big
uh,
time.
uh, on that. So you're going to test the waters, and you you wish them the best, but it's like, hey, just checking in, making sure everything is still moving along as planned, because we can still close quickly
Yeah.
on a particular structure. And I think we will be the first to say, hey, we are not the best lender for every deal. Uh, Here, you spend a lot of time sharing and educating and letting people know what our go zone is. You talk to some lenders, they're like, it's kind of aggressive. You talk to others, and you're like, they say, that's a little conservative. But when we issue terms, we've put eyes on that asset. We're confident
Yeah.
in the structure. It's quoted within a very tight range. And if you need to close in X amount of days, here's what it's going to take to get there. I mean, at times, we're working on one right now, another deal of the week that is falling through, but it happens. But due to the tight closing timeline, we knew there's going to potentially be an entity issue on being able to bind the entity.
Yeah.
But it's in issuing our soft quote or our LOI, since we are a loan committee for the company, it's like, hey, Mr. Borrower, here's your fucking underwriting conditions that will come out of underwriting. I'm
Right.
saving you 10 days. Like,
Right.
I don't need to look at the file to tell you what we're going to need.
Yeah.
So doing little things like that, it's fun, but it's a double-edged sword. If I lay out 15 conditions I know we're going to need, they might just go elsewhere because
Yeah, but I
they don't
think
want to get it. But for the most part, on commercial deals, when we do that, especially coming through mortgage brokers, they respect that more because now they're going and ideally in one clean swoop with their clients saying, hey, we shared the situation, we shared the scenario. This is going to be requested out of underwriting no matter where we go. They're
yeah.
doing us a solid by letting us know on day 3 before it's even submitted to
And
underwriting. So,
oddly enough, too, what we've experienced on the commercial side is they already have all that stuff.
oh
And
yeah,
that's the interesting part. It's the residential side that it's like, why you guys need so much stuff. But I think ultimately, with that explanation of how on the deal that we're referring to on the needs list, that's the difference, in my opinion, between a true asset based private lending company and somebody or something else that is more institutionally based, right? I mean, ultimately for us, if the asset checks out, it's not very difficult to value an asset within a range. We're not trying to be exact. What we're trying to do is make sure that our debt exposure, our leverage, is going to be protected by a certain level of value in the property. And so, ultimately speaking, I think people hopefully can find value and respect the fact that when we do send out the needs list, after taking a look at the asset's kind of checked out at that point in time. So now it's like, just provide us with the documentation and we're ready to go. I think a lot of times when you get into the institutional space, it's a send everything in so we can verify, and then we can get an appraisal or 2 valuations to make sure that we're okay. And
and
there's, there's
if it appraises, we should be good. I'm like, look at the asset right now. It's SFR.
right.
Like, wait,
Well, yeah, but if it appraises, we should be good. How many appraisals have we seen where we're like, what in the heck is this? Yeah, right. And so I don't know. I think that I mean, a funny story about appraisals. I just wanted. I always love telling this story. Is when we were doing some stuff out of state with some institutional stuff, right before COVID, and we did a deal in Texas, and the requirement from the lender was 2 valuations, and we get the first one back. We go back into one of the appraisal management companies, and we order a second one. 5 days later, it comes back. Value is fine on both. The same person did both evaluations. The same exact person. And I remember calling you and saying, do you think this is going to be a problem? And you're like, let's look at the underwriting guidelines. It just says 2 valuations. It doesn't say 2 valuations by 2 different people. I'm like, yeah, but if I was a lender, I would be like, what? Like, this guy just got paid $1,000 to do the same evaluation? Like, that was
easy money, baby. I
not even.
remember that. So what we did that on, I reached out to that lender, yeah, because when we're brokering stuff out of state, and I said, hey guys, we got the appraisal. Here's our comps. You agree with the comps. We got your secondary valuation. The appraiser did the BPO. Like, are you cool with that? And they said, it's a secondary valuation. We're good.
Oh,
I
my
was like,
goodness.
so I actually drafted a memo and put it in our file
Yeah.
and attached their
Yeah.
email confirmation. Like,
But if that doesn't show you the inefficiencies of some. Well, I mean, whatever.
yeah,
If that doesn't show the
they're
inefficiencies of what's going on, I mean, there's that at scale is a scary situation because I mean,
I think we're seeing some of the beginnings of it. I'm not saying market crash or anything of that sort,
no,
but having some of those. So there's a difference. I mean, I'm going to backpedal. Our
do it.
underwrites aren't perfect. Everything we require is not perfect. We miss things. We probably should request things that we don't,
Okay.
but it fits our
I don't. I
parameters.
don't
And what
agree. I don't agree
I
with
know
we
you don't
request.
agree.
I don't think we should request things that we don't. I think that I just want for any investor that invests in our trustees, I just want them to know I wholeheartedly disagree with that. I think we get you, Mr. and Mrs.
Well,
Investor,
you didn't.
everything that is needed. Okay,
You
that's
didn't
all
let
I want to
you
say.
didn't let me finish. Let me finish my thought. Where I'm getting at, no one's perfect, but
Right.
based on our experience over the years, it attacks the pain points on where I feel are high levels of risk in a transaction. You talk to an institutional lender or a different investor, they would say, "Hey, no, this is a more
Right.
high level part of risk in the transaction.
Right.
My my thing is the great equalizer is skin in the game. I don't care if you have an 820 credit score. If you have 25 loans outstanding that are all high leverage fix and flip, it's these don't
Better have a lot of
report to
money in
the
the bank.
these don't report to the credit bureaus. So push comes to shove, you're like, take it.
Well,
Is it my LLC? Yeah, might taint me or whatever. But hey, sayonara. That's just how it works.
yeah.
And they could just set up a new entity, not even associated with it. And if you don't know how to underwrite that transaction to verify that schedule of real estate or that name, like that, that can be a challenge. That's where I think a lot of risk is. I would much rather do some of the structures we do. I mean, we work with first-time investors all the time. Some
Right.
borrowers that we've done deals with low 600 credit score, but they're coming in with more. But they're coming in with
Mhm.
more cash to close on that, and that's where we feel our underwriting a lot of the risk is. Now, these other lenders, we need a secondary valuation. We think the valuation is where a lot of the risk is at. Okay, like I don't care how many appraisals you get. They could all be high. They could all be low. But it's that skin in the game, the protective equity where a lot of that risk is at. And it's also post closing. I don't think lenders talk about it enough. I don't think investors talk about it enough. It is of my belief that a majority of the risk in every loan that we do occurs post closing or as part of that closing process. The disclosures, the docs, and the loan servicing procedures post closing is where a
Right.
lot of the risk is baked in at. Look at this bill coming through right now. Prime example. It's heavily procedural based for loan servers that can make your loan unenforceable. So having that swoop through, I mean, it's not to talk about that, but just in general, it will be it is post closing procedures on loan servicing, calls, follow ups, construction, rehab, draw releases. What do those look like? Your title insurance. What endorsements are you requesting? The coverage
And
on that.
are you getting them? Are you getting them?
Well, the thing
Right. That's
is,
the other
where
part.
it's I talk to some investors like, well, I or lenders, I get my title signs my lender's instructions. So basically, I'm summarizing it. Fuck it, I'm good. And I'm like, well, have you met exclusions 3A and 3B in your title policy? Because what those exclusions do is say you're going in, you're doing a mid construction loan. They need more money. You're just giving them a refinance. You're not doing a fund control because maybe it's almost done on that side of things. So it's not going to alert title that there is rehab work going on. If you know there's construction work going on and you don't tell title, and they still issue you your extended Alta 125% coverage, and then a mechanics lien pops up, and then you go to submit that claim, you know what they're going to do? They're going to review the file. They're going to see if you have an appraisal. They're going to see when that work started, and they're going to ask you, did you know that this was mid construction? You say, yeah, but you signed my lender's instructions.
Yeah.
They might just say, this full disclosure, I am not an attorney. I'm not your attorney. You should consult your title attorney. But they might just say, well, since you knew that construction work was going on and you did not tell me, that's an exclusion
Yeah.
from your title policy. So we're not paying out this claim. So things as little as that.
Well, and
Again,
I think
closing and post closing type procedures that will bury you.
circling all the way back to CMA, I'm fairly certain that CMA has been around for a long time. There are members of that organization that have been in business for 30, 40 years. They've seen this happen. And so that's why I believe what's a huge value is being in the loop. And I think the more I start learning about what bills are trying to be introduced and what changes in the, I just get back to this full circle situation where it's like, how would our company know about this stuff if we weren't involved with CMA? And I think it would be very difficult because I'm not reading 215-page bills that appear on the cover as nothing to do with real estate
Yeah.
and so on and so forth. So That's why I'm appreciative of the El Jefe Presidente, Brad Ladisaw of CMA, and I will proudly be FLOTUS until his term is over. I just haven't seen any benefits from it quite yet. Personal benefits, obviously the business, but I don't get wined and dined. No gifts come my way. I don't get thank you letters, but I receive a bunch for Brad in our PO box when he gets them. So congrats, kudos to you. So it's an interesting time, man. I think we've seen clients. The selling market is a lot different than it was 6 months ago, and when you have
That's what I
repeat,
wanted to ask you. What are you seeing out there? What from our borrowers that are tail end of flips, mid flip? Like, what's been going on?
I mean, I think if you bought something in the last 2 to 3 months, generally speaking, you're probably buying them at better prices than you ever have because the market has cooled a little bit. There's, a little bit more inventory. It's all area dependent because there are certain areas that there's a ton of inventory. And ultimately speaking, I was having a conversation with a client of ours who's relatively active, repeat borrower. We love the repeat borrower position. We've been doing deals with this borrower since it was his first transaction. And the interesting thing about it is we love to see that growth, but we get to a certain level in the relationship where we can chat about what's going on. He mentioned a very interesting thing to me where I thought, hey, like a proud parent at a soccer game, right? Or something like that, because it was a realization that he made. He has a couple listings right now that are not selling quite the way he wants. He's not upset about it. It's a reality. He's handling it well. But he focuses on quick renovations to get them fixed up and sold. And he said something to me that kind of encompasses what the market used to be in comparison to what it is now. And he said, listen, man, at the end of the day, we're selling old houses. You buy a house that probably has been lived in for 30, 40 years, maybe hasn't been touched very much from a renovation standpoint. 3 years ago, you do your cosmetic rehab, people buy that house as is. They don't come back for seller concessions. They don't come back for price reductions, requests for repairs. He goes, now I need to start thinking about repiping houses day one. I need to start talking about rewiring, whether or not it appears that it needs to be. The mechanicals from the guts out need to be kind of taken into account and addressed, because if not, and we're just doing the really good remodel, opening up a floor plan, doing all of this, you're still selling an old house. And so I thought that encompasses where the market is right now. I think we have a little bit of a cooling off. If you don't hit your price point correctly on your list in the first 2 to 3 weeks of that listing, the listing gets staled. And once it's stale, now you're in this rat race of feedback from buyers or potential buyers. Should you correct those issues, pull it off the market and list again, correct those issues through request for repairs, or what are you going to do? Because the interesting part about this conversation with this particular client was he had to put a fence in, so he put a fence in. Then he wants to put a little bit of a landscaping improvements to make it a little bit more secluded. And one of the things I mentioned to him was there's got to be a point in this process where you're done, because ultimately speaking, these properties have been on the market for 45 days on and off, right? Trying to reposition it and everything like that. But you're making changes for buyer feedback for buyers that were in the market 2, 3, 4, 5 weeks ago. And if you make those improvements, is the new slew of buyers that are coming on the market going to receive them? At some point, you have to just drop the price to a point where you want to do it. Maybe it's a combination of doing the work and dropping the price, but be careful, I would say, continuously improving the property for feedback that you've gotten from buyers who probably are no longer buyers. At least for your property, they're not. And so
you're putting yourself in a spot where you're potentially throwing good money at a bad deal. Rip that Band-Aid off. Again, we're not your agents, but rip that Band-Aid off, do the sizable price drop, because if you take it off the market to reset that listing, you do the updates, you relist it in 3 to 4 weeks, you have also made another monthly payment. And then by the time that is accepted, chances are you'll be making another 1.5 months worth of payments if all goes as planned. So
Right.
it's not as much as just doing this. So it's like if I put $5,000 into the property, I need to get greater than $5,000 worth of value. And if
Yeah.
it's that, so it's just,
Well,
you said
it's
something
interesting.
very interesting.
Yeah, it's
You
interesting, but
said,
just to jump
no,
into that real quick, it's yeah, real quick, buddy. Come on. Real interesting about that is
mute.
do you feel that the property is unsellable without making those improvements, right? It goes back to price. I genuinely think that if you have a renovated home, the minor things, the fence, the tree, the plants that'll make it a little bit more secluded, whatever it may be, those aren't going to make a property unsellable. So, like to echo what you were saying, maybe it's best to not spend the $5,000. Maybe it's best to drop the price 25 and try to get somebody in there that's okay with those things not being done. But I digress. I didn't mean to cut you off and
And
make you
that's a
feel unimportant.
conversation you need to have with your agent or broker on that. But you said something very interesting that I
Finally.
laugh about and we talk about from time to time. You said you have the property listed from two to 3 weeks and now it is stale. You rewind back to 2013, 2014, average days on market across the board is like 40 to 60 days.
Right.
But we are in this post-COVID era, we are just so used to you list it, two open houses, maybe across, or 2 weekends of showings across, call it 10 days or maybe just 7 days, and you have offers. Now you have to, especially in some markets, have the increase in inventory, and to our borrower's comments that he had made on some of the requests and things he's thinking about doing and where we're at in the marketplace. The and I've yelled this at the rooftop, especially in the above $1 million price point. The strategy, and I apologize in advance, real estate agents trying to double in and triple in deals. This one, um, you need
Zing.
to. So the strategy of, I don't care. It needs to be said. The the strategy of giving your real estate agent the listing just because they source the deal for you on the front end needs to be freaking thrown out the window in some markets. Some real estate agents are extremely good at sourcing deals and negotiating those acquisitions. Other agents are extremely good at marketing that property. They're in a strong office that has a deep agent and broker bench, and they are able to achieve top dollar. Very rarely do you find the Bo Jacksons of real estate agents that could fricking do it all.
Yeah.
It's very rare that you have an agent that is strong at sourcing and negotiating those acquisitions, that is also extremely strong at listing and selling and marketing properties. You
Absolutely.
get into the higher price point properties, it's highly recommended. You could do whatever you want, but find an agent that specializes in that market, that has a deep bench in that office and a deep network to market that property, and pay them for it. It's
Oh God, yeah.
it's like you, nickel and diming on maybe an agent commission fee might not be the best thing in this market in certain price points. Slightly against the grain, but that is something that I've shared quite loudly, and it's funny. We talked to some borrowers that we've worked with where they've implemented that strategy, and you know
Yeah.
what happens after 60 days? They end up pulling that listing from that agent and they give it to someone they should have given to on the front end that specializes in that market, and they have wasted some time.
Dude,
And it's not
yeah.
foolproof. I mean, markets are
No, but
shifting quick,
I think,
but
yeah, I
I
think
think
that,
that strategy should be park
well,
it.
I just think that we have the luxury, I guess you would call it, right? We have the fortune to sit in a spot where the negative situations that we've seen over the years of what we've been doing, they tend to stick in our memory more. It's like when you compete, you probably remember the close loss or the one thing that you could have done in a game that would have helped your team win that they didn't win more so than some of the successes, right? And so we are in a position where we have had clients who've had experience in this exact scenario, and it has hurt them ultimately to a point of thousands and thousands and sometimes 5 or 6 figures. And so my kind of play on words is, gone are the days where your cousin who has a real estate license can just list your property and get a lot of offers. And then circling back to this sale after 21 days, most of the time that has to do with price. So if you miss your price market or your price point, whatever that may be, and you let it sit there, when you do a price reduction in this market, it's not as appealing as it was 2 or 3 years ago. And so ultimately speaking, 2 or 3 years ago, you lower a price 5%. Now you've brought in a bunch of buyers who like the house, who want to buy the house, who have an attractable interest rate, all of those kind of things. They're more motivated to purchase that property with the price reduction. Right now, we're not really given those same positive aspects in the market. So even a price reduction, I feel like people are just in a mentality right now from a buyer standpoint of reasons why they should not buy something, as opposed to, I have to buy this place, otherwise I don't have a place to live. And that's the mental shift. It doesn't mean the market is crashing. It doesn't mean that we're going to see 20% decreases across the board. I just think timing and strategy around the list is far more important now than it was even 12, 24 months ago. Really. I mean, it's happening right in front of our eyes this year. And this summer, I think we'll see less of a summer bump than we normally do. I think we'll see more activity in comparison to other parts of the year as we traditionally do. But I think we're just in a cooling period where buyers are becoming more particular. Things in the economy haven't gotten better. And the date the rate and marry the house folks from 2 or 3 years ago, that stuff is falling on deaf ears because you're sitting here going like, all of that stuff didn't happen. So the mortgage broker who did the phone call, convincing somebody to refi out of a 3.5% rate so they can get cash out because just in a year from now, rates will be back down to 3. I'll never forget that. I'm glad that guy took down that video.
But did he take it down?
Oh, of course he did, right? And it was one of those guys. But you sit there and you go, we don't really know with a high level of certainty where the market's going to go, where rates are going to go, and that has fatigued buyers to a point where they're just more particular. And I would argue probably more particular in a good way than what they once were when the market was in such a frenzy. It is a very big purchase for people, largest purchase of their lives. The chaos that was 100 offers on one property is not a healthy market either. So we got to find that balance. We have to find what a new market feels like and looks like, how your strategies as a fix and flip investor or somebody who's been holding on to a rental, when you go to list, what is the strategy that makes sense? And it's more important to talk about that with your agent right now than it has been in the last 5-6 years. And so you really need to take the time and effectively interview the agents that you're trying to list your properties with. Get back to sitting down across the table with somebody, asking them their strategy, what are their measurables, how are they coming to their conclusions. Make sure that you're comfortable with it. You want to hire, as Brad mentioned, professionals that specialize in the area and the property that you're trying to sell. That's it. That doesn't mean you have to be a professional and specialist in the selling of that property, but you have to have an idea. This is your investment. Trusting people is great. We want to work on a trust basis, but you have to verify that they know what they're doing. An answer of I don't know in something that you specialize in is probably not acceptable, right? So you really want to have that level of confidence. I would strongly recommend getting away from the automatic, if you find me a property, I will relist it with you. If you find me a property, you will be considered to relist it. We'll have a conversation about that. I want to see what else you're working on.
You're on the short list.
You're at the top of the short list. Yeah. But I'm not guaranteeing that you're going to do this because, frankly, it doesn't seem to be working all that well with some clients out there. And there are cases that'll contradict exactly what we're saying, but we've seen it. We continue to see it.
Again, said whatever works for you. And they saw we're gonna wrap up here. Rapid fire. I just jotted these down real quick.
All right.
You pick one or the other.
Oh boy.
Taking the three or driving the lane.
Taking the 3, man. I'm 5'9".
Yeah. Driver on a drivable par four. You laying up.
No, I'm not good. I'm not good enough at golf to make smart decisions. So we're definitely going for it.
What would Tin Cup do, baby? Got to ask
I mean,
yourself that. Ball me, Romeo.
79. Romeo.
Skiing or snowboarding?
Skiing.
Pro
Although
V
I
or
do,
Taylor? Pro
although I
V
do
or
have,
Tailor Made?
oh,
Don't need
okay.
explanation, just answers. Pro V or Tailor Made?
Pro V.
Ocean or pool?
Ocean.
Pool.
I live in Brea, man. It's not.
If you have to think that hard about it,
I
not
mean,
the ocean.
I prefer the ocean, but I go to a pool more often. So, okay, I'll go with pool because that's what my backyard. Yeah, not my backyard, definitely, but that's what I circulate here in the summers more often.
That's all I got for you.
No. That's it. That's it. Okay. Um, I don't I don't write down random things to ask you. I'm trying to think of something that would kind of bookend this thing. If I'm gonna go not yes or no question. Um, no, I don't have anything. Yeah, I don't have anything. I was trying to think of something on the fly. Improv skills need to be worked on. But tell us about, how about this? Instead of doing that, you've created and helped put together a couple of networking activities. And I'm very happy that you're doing this. I was telling Kristen about this earlier on the phone because you have found things that you enjoy doing that other people in the industry enjoy doing. And it just seems like the most obvious thing to do is to combine those two things together. And so tell us about the networking events, one that was on Wednesday night and the Friday morning stuff that you're doing, because I think like when you're in business and you listen to somebody say, find people that like what you do and meet them over, drinks or whatever, or find topics that you like to discuss. That's how you're going to build rapport with people. And you're living it because it's really not that difficult. Just there's more people out there that enjoy what you do than you think. So outside of running away from your responsibilities, why don't you tell me what's important for you to do?
And so we joke around. It's find something you like doing, invite your friends, and then you could call it a networking event. So one of them has been, and it's been teamed up with Ken Rodriguez and Corbin Dooley. Another shout out to those guys. We've been once a month meeting at the Bermuda Club in Carlsbad. We got a private speakeasy room with the golf simulator. Literally, there's no registration link, no events link. It's just text messaging, LinkedIn posts. We keep the head count around 25, 30. Just connecting real estate investors, lenders, brokers, bankers. We have wealth advisors there. We have plumbers there. It's just
Insurance.
connecting our network there over a golf simulator and some beers and sodas and waters if that's your fancy. And with the no registration link, there's no follow up drip campaign you're getting in. There's no pitch. There's no say here. Here's all the education you're going to get from coming and swinging the sticks at a golf simulator. It's like, nah, just people in the industry talking shop. And then the second one we're going to be doing throughout the summer, and this was not my idea. It was Mr. Carl Maggio's with Maggio Capital. He just moved back to San Diego from Arizona, and we go surf every once in a while. And he's like, shit, man, we got to start surfing more on Fridays. I was like, let's do it. He's like, what if we had like a mixer or a meetup? I was like, fabulous. Let's do some posts. That one's been growing like a wildfire. We get anywhere from 6 to 12 guys across the debt world and insurance space. I mean, we got a couple CB guys on their valuation team that make it out. We got a couple lenders that will bring their kid early in the morning and talk shop. So we meet at just south of the Oceanside Pier around 6:15, 6:30. We have tailgate style, a couple jugs of coffee and bagels and cream cheese. We talk shop for 30 or 40 minutes, and the guys that want to go surf, we suit up and go surf for an hour and a half and move on our merry way. So those are
Yeah.
two things we've been doing, and it's great. Like after the surfing meetup, we got some guy meetings are set, deals are gonna be closed. the golf simulator event. You got guys setting meetings, talking shop, deals will be closed, and it's just getting to know people, getting out from behind the logo. So that's what we're doing and having a good time doing it.
Yeah, and I think like for those of you trying to think of ideas on what you can do for networking events, we're always big advocates for that. So if you have an interesting idea, you want to kind of partner up or at least spitball it and spread it out on social media, we'd be happy to share it. And pro tip from Brad, I'm going to speak on his behalf. If you start organizing events, the beauty about that is you get to organize them within a 10-mile radius of your home. And maybe Carlsbad's a little bit further. So you'd cut down on the commute as much as possible. And I don't know. It's pretty cool to see. I'm going to make it down to that golf one again. I went surfing one time in my life and my calves cramped up swim paddling out past the break. So I haven't been really on a surfboard since. I may have to make it down there for that. But definitely the golf one. And yeah, been a lot of fun, man. This one ran definitely longer than 30 minutes. But a lot of important stuff to talk about. And yeah, man. Just another
Until next time, baby.
Just another conversation with Brad and Corey.
Yeah, not a podcast, just another conversation. Take 3.
Take 3. 3 is my
All
lucky
right.
number. Later, buddy.